When we talk about internal controls, the asset that is most at risk is cash, or what we will talk about in a few minutes, the cash equivalents. They are the most liquid, they are the easiest to come up missing, and the hardest to replace. So we want to control our cash and protect that. And that involves having people who are responsible for the record keeping and people who are making payments and people who are receiving the cash and taking those deposits to the bank all separate. And to the degree that we can separate that, even break it down further, we've got cash receipts promptly deposited in a bank. So we would want to have that done, daily or maybe even twice a day, depending on how much cash we have coming in. We would want the person who was collecting the cash be different from the person who was actually depositing the cash. And we would want to have the person who was recording the deposit separate from the person who was making the deposit. So again, the degree to which we can segregate these duties means that it will reduce the opportunity and increase the likelihood that we will discover something before too much money goes missing. So again, we've got cash equivalents, and the concept of liquidity. Cash is just what you think it is. It's coins, it's paper money, but it also includes the money in our bank accounts. It includes money that, if a customer writes us a check and it's still in the bank bag and hasn't been deposited yet, we still consider that cash. We also have something called cash equivalents, and those are investments that are highly liquid and we could turn them into cash without a lot of effort. If you had a certificate of deposit, a CD account that was a 30-day CD, we can turn that into cash pretty quickly. Certain investments, certain types of securities, we can cash those in pretty quickly and turn those into cash. So when we talk about cash, it's both cash and cash equivalents. So the idea of maintaining our cash really has two goals. First, we want to make sure that we have enough cash on hand to meet the payments and only enough that's necessary to function. We don't want to have our operating account look like a huge slush fund. We want to just keep what's in there, what's necessary. There's a concept called zero balance accounting, where the operating account where money is dispersed only contains that which is going to be paid out over that particular month, and any excess cash gets swept out and is held for investment. You can, keep it for a planned expansion or something like that, or to replace pieces of equipment, but you want to segregate that out from your operating cash, and it just reduces the chance that if there's a problem, if all your cash is in one place, it's really easy for lots of it to disappear at once. If it's spread out in multiple places, then if somebody manages to get access to one of the accounts, what they're going to get is going to be pretty limited. And so you're probably feel like I'm beating a dead horse here a little bit, but the odds of a problem in the cash handling process is so substantial that it really bears going over this repeatedly. Having anyone in a physical cash handling function creates an opportunity that rather than the money going in the cash drawer, the money just goes in somebody's pocket. So we've got cash registers with tapes. We've got then a cashier's department that's going to then count, or a manager at the end of the shift that's going to count up the cash drawer and compare it to the tape, and then that information is going to go to the person who prepares the bank deposits, and then you again may have somebody else that actually physically takes the bank money to the deposit, or maybe you have if it's a big enough place, you see the armored car people, they come in and they take it, and you don't want to those armored car people, they're not fools. If something's missing, they're gonna, you know, who's an easy one to blame? The cashier says, I don't know, I gave it to the armored car drivers, they must have taken it. So the armored car people are going to certainly make sure that what they're given and, or it's going to be secured and they're not going to be able to touch it, but they're going to cover themselves and ensure that anything that they take custody of is either completely inaccessible to them or fully accounted for at the time that they get a hold of it. If not, imagine, it'd be a field day for anybody driving an armored car. But anyway, and then of course you're going to have a supervisor that's exercising oversight over all of that stuff. Now, sometimes it happens. Sometimes there's a shortage in the cash count, and it happens. And it doesn't mean that somebody's committed fraud. It just means that somebody just didn't count right. And it happens. The way that we account for that is that we have an account that is called cash over and short. And whether or not that is a debit or a credit depends on whether cash is over or short. So in this case, we've got a cash register record that shows it should have been $550, but what we find is $555. Kind of a less common situation. More often you're going to find the shortage than the overage, but in this case we've got the overage. So now we need to make our records match the physical cash that we have. So our debit to cash is $555. We've got the sales of $550, and now we've got to credit the cash over and short to make our transaction balance. Here is the flip side and the more common scenario where we've got a cash shortage. And so we've got sales of one amount, but cash not quite adding up to that, and we've got to be able to close that loop and make sure that our transaction balances. So here we would have a debit to the cash over and short account. Now, hopefully people don't still do this, but it could happen where people send cash in the mail. And there needs to be a system to open the mail and ensure that any cash that comes in is accounted for and properly deposited. Back in my very first accounting job, back in college, I was probably 19 or 20, and the accounting firm that I worked for did audits of nonprofit organizations. Wasn't anything that I was involved with at that level, and that was probably why they ended up using me. I noticed that I started getting mail from many of the nonprofit clients that I knew were audit clients of the accounting firm. And come to find out, my bosses, in order to check the internal control for cash receipts at the nonprofit, would use the names and addresses of the clerical staff people in the office who were not on the audit engagement, so they were unlikely to be known to the client, and they would send in cash deposits in our names. And so I was getting, all of this solicitation mail from all these nonprofit organizations that we audited wanting more money. And so what would happen was my boss would put $10 in an envelope with a little note saying that this is, for the donation. And then when they did the audit, they would look on the cash receipts journal, they would look in the deposits, and they would ensure that the donation had been properly recorded and deposited into the bank. I'm not sure that they ever understood the level of junk mail, which I got forevermore after that. But when I found out, I was a little irritated that they didn't at least ask my permission before they did something like that. It was a long time ago, and they probably would know better now. So when we've got cash payments, which happens not that often, but we want to make sure that we have controls over cash going out as well as what we just talked about, the cash coming in. So any cash going out, we want to make sure ideally is done by check. We'll talk about petty cash shortly, which will be an instance where, cash will go out the door. But ideally, if you've only got payment that's going out by check, it's a little more difficult for somebody to just, forge a check and change that. We want to make sure that people who are signing the checks have authority. You will often see on a check that, it'll say 2 signatures required over a certain amount. And then if the check amount is over that, then it's got to have dual signatures on it. And now we want to also have some sort of a system for ensuring that payments that we're making are legitimate payments, that they are legitimate vendors. That's a common scheme where somebody who disperses payments will come up with a dummy vendor and make up dummy invoices and then issue payments, and really it's the person's company that they've made up, and so that's a common way for fraud to occur. A voucher system is one of the ways that eliminates that, so that the person who's preparing the checks is different than the person who's signing the checks, and that's different than the person who's mailing the checks. And at every point in that chain, we've got some sort of documentation through some sort of a voucher or purchase order or something that ensures that that transaction is legitimate. If it's for items that we've ordered and we've got a receiving department that is separate from our finance department, it would be easy for the company to just send us a bill, we pay the bill, and we don't know whether the stuff showed up or not. So we want to make sure that if the receiving department gets the items in, that there's a receiving slip and that's matched with the packing slip and the purchase order, and that all goes to the accounts payable people. And so there's a whole chain. So by the time a payment actually goes out, there may be quite a bit of backup documentation associated with that to verify the validity of the transaction that's about to happen. And so this is just kind of a graphic that talks about that series of events. Won't go over that so much. And so I'm going to stop here and go on to the next video to talk about petty cash.